The range trading strategy, easy wins in sideways markets, is not about predicting a big trend. It is about recognizing when price is trapped between support and resistance, then using that box instead of fighting it. I think that is the most useful way to think about it. Range trading is a location strategy, not a prediction strategy. And the part most beginners miss is simple. The method only works if the market is actually moving sideways. I'll show you how traders define that, how they try to use it, and why the easy wins part can disappear fast if you ignore one key filter. A range is just a zone where price keeps bouncing between a floor and a ceiling. The floor is support. That is the area where buyers have shown up before. The ceiling is resistance. That is where sellers have pushed price back down. Traders use this by buying near the bottom of the range and selling near the top, or by waiting for clear rejection candles before entering. The logic is plain. If price has failed 5 times to break above a level, that level matters. But the trade is not buy anything near support. It is buy only when the market still looks stuck. Here is where many people get it wrong. They draw 2 lines and start trading every touch as if the range will last forever. That is a weak habit. A range is temporary by nature. The market can spend a long time chopping sideways, then suddenly break out hard on news, volume, or a shift in momentum. So the first job is not entry. It is classification. Ask, is this a true range, or is it just a pause before continuation? If you skip that question, you are not trading a range. The cleanest way to use the strategy is with confirmation and risk control. Traders often want a bounce signal near support or a rejection signal near resistance. That might be a candle that closes back inside the range, a failed breakout, or simple loss of momentum. Then they place a stop just outside the range, because if price leaves the box, the idea is usually wrong. That matters more than people admit. In range trading, the stop is not a nuisance. It is the proof that the market has stopped respecting the box. The biggest limitation is that ranges do not pay you for being early. They pay you for being patient. If the range is narrow, the reward may be too small after fees and spread. If the range is wide, your stop may need to be wide too, which makes the trade less attractive. So the strategy tends to work better when the range is clear, the boundaries are respected, and the trader is not trying to force a trade in the middle of the box. In the middle, the odds are usually worse. Price has no reason to choose a direction there. A useful rule is this. Range trading works best in calm markets with repeated tests of the same levels. And it fails most often when volatility expands or a breakout starts to hold. That is the real trade-off. You get structure, but you give up certainty. So if you want easy wins in sideways markets, the honest answer is that the wins are only easy when the market truly stays sideways. Once it stops doing that, the strategy stops being a shortcut and becomes a trap. The skill is not finding any range. It is knowing when the range still deserves to be traded.